Could I just go back to the question of pricing? Do you think prices have been driven up quite unnecessarily high? And why do you think that's happened? Is that because there are specialist infrastructure funds around now?
I think there are some assets that are very competitive. So if you take the recent deal that's gone, I wanted to pick on a particular deal, but if you take the United Utilities wires business that's just been sold, that had particular characteristics. One characteristic was it had an operating contract that United Utilities remained the operator of the business. So the business was effectively de-risked from an operating point of view. Yeah, so and that makes it a simpler asset to value. The other type of assets are things like operating wind farms in Germany. They're very simple assets. They've got long-term stable contracts. So you've got an operating asset as long as you can take a good view on the wind resource. You've got your financing in place. The returns on those should be reasonably low. Roads have traditionally been reasonably low return assets because of the stability of the cash flows. So it really depends on the asset. If you then look at something much more complicated like hospital portfolios or merchant generation assets with some contracted contracts on the back of them, those will be much more higher return assets, and therefore the competitive landscape will be a little less. So it just depends on what you're looking at, really.
But it is interesting that when I first became involved, certainly in the PFI market, the first deals I closed were back in 1996, 2 roads deals. And really, in those days, you couldn't get equity for love nor money because it was the contractors that had to invest. And the contractors themselves were cash-strapped. They're cash flow business operating on very small margins, not wanting to invest long-term. This isn't a criticism at all, but just a characteristic of that kind of corporate. And the investment world, this is an overgeneralization, really did not understand infrastructure. The funds hadn't been set up. There were, as we mentioned before, the Australian and the Canadian pioneers. In this country, the privatised utilities had been established, but weren't really thinking at that time of investing for profit in terms of equity realisation. And here we are, only 11 years later. It's an incredible change that has taken place, and companies have set themselves up as facilities managers, as PFI has really taken up. We're talking UK. Funds have set up specialist funds for PFI. Infrastructure funds. There is a lot of equity around for investment into this asset class, and a lot of it has just been coming to terms with and understanding infrastructure and understanding what the management of infrastructure requires, the identification of infrastructure, and these were. There weren't skills around then. One of the very first UK deals was second Severn Crossing and second Dartford Crossing, and these were real. Second Severn Crossing was a real pioneer deal. You had an institution which invested in that, the Prudential. There was an instrument which it could invest in, bonds. But really, the deals weren't around, A, because the government wasn't putting the infrastructure out to the private sector. It was much more the old post-war consensus of infrastructure in terms of transportation and social infrastructure will be delivered by the public sector, by government or local authorities. And the asset managers weren't focusing on it as an asset class. And the corporates weren't there to deliver it in a way. And what's happened since the early 90s in this country, maybe further back in Australia, Canada, is incredible. It's a revolution. It's sort of an investment revolution, really. Not wanting to over-dramatise it, but a complete sea change.
Martin, do you think, looking across Europe, governments have been, regulators for that matter, have been obstructive, or are they being increasingly helpful?
I don't think they're being. I don't think they've been unhelpful. Certainly haven't been obstructive. I think it's a question of evolution, really. And I think it's only recently, if you take utilities, for example, it's only recently throughout Europe that there is actually regulatory frameworks where you can actually see how you can price some of these assets. So, and it's only very recently that there's been a separation of distribution companies from generation companies. And until you get that sort of separation, not through ownership but through license, until you get that sort of separation and you get clear transparency, it's very difficult to value some of these assets, and that means that it becomes very difficult for private sector individuals to come in and acquire them. And I think that's just a question of time, that and the evolution of regulatory systems across Europe.
Regulatory risk is an interesting risk in the concept of infrastructure finance, though. And one of the current assets which is on the market is Angel Trains. And there's a Competition Commission inquiry going on at the minute into the pricing of the Angel Trains model. As also there is an ongoing Competition Commission inquiry into the pricing of the regulated airports in the UK. And at the same time, BAA Ferrovial are trying to deliver a new capital structure to BAA, query what the pricing metrics is going to be, because there's this ongoing Competition Commission inquiry, and the Royal Bank of Scotland is marketing Angel Trains, and query what pricing metrics Angel Trains is going to operate off. And at the same time, there is market appetite for these assets. So it's interesting to see the view the market takes to regulatory risk. I don't know if you've got any thoughts on that?
I mean, I think it definitely makes the valuation of these assets far more difficult, right? What will be the outcome of these reviews, and what will be the final, regulation, tariff setting is a big question mark. So, people, and we share that. I mean, people, are in the mindset that eventually the regulator will want, and the government will want the service to be delivered anyway. So they need to find a suitable balance. But there is quite a big margin of error between cost of capital that are set, and you can end up with very different outcomes.
Looking across Europe, I think what's important there is getting precedent, because the more you get precedent on certain decisions, regulatory decisions, the more you're setting the envelope of what's possible, and therefore from a rating point of view, for instance, the less uncertainty that something ridiculous can happen out of a regulatory review, and it's relatively predictable and therefore financeable. So Nick's right, where you've got political uncertainties, for instance like Angel Trains or around the review on BAA, it's going to make it much harder to finance. If the uncertainty is actually relatively confined, much easier to finance, and equity can take that risk.
Well, I spend a lot of time talking to governments and regulators around Europe, and the one thing I say to them is, look, we're not asking you to guarantee that we can continue to feed ourselves, not asking for a guarantee of that. But what we are saying to you is, when you put a regulatory framework in place, please make sure it's predictable, understandable and stable. Please make sure you put that environment in place, because if you put in place a regulatory framework that lurches from one year to the next across the spectrum of economic returns, it's very difficult for banks to finance against it. It's very difficult for equity to determine what the value of its equity should be in that business, and it makes investment very difficult and very hard. The result being that you get a lower investment in infrastructure, and the government's requirement for expansion of private sector infrastructure never happens. So stability of regulatory frameworks is really important across all of the sectors in the infrastructure space.
So often you get, when dealing with governments, just this thought that, well, the private sector can sort it out, or the private sector are good at these sorts of things. But actually giving the private sector clarity about either the regulatory environment or the confines or whatever, we respond better, because we can price it, we can understand what's going on. And quite often the danger is the government will try and use the private sector as the grouping that takes difficult decisions when they should have been taken by government. A classic example, I was advising on a hospital, a new bid hospital, where actually there was a thought about that we have overstaffing. Let's transfer and make the private sector build this hospital, and they can solve the staffing problem by sacking everybody because they're good at that sort of thing. And I was saying completely opposite, which is the private sector one, aren't necessarily good at that thing, and two, what you were talking about is a political decision about the right level of staffing is a government decision about health services. Government should make that decision, make it, and let the private sector then price whatever decision they come up with.
Just going back to this regulatory point, I think there's if you take the renewable energy space, where there's a huge demand for new infrastructure in renewable energy to meet the Kyoto targets and more stretching targets that are going to come in, and you look at the different approach that different governments have taken across Europe. So, for example, if you look at the French approach, which is very helpful for an investor point of view, there's a standard tariff, you know what returns are going to be. You have to take a view on the construction cost, you have to take a view on the wind resource, but you know what you're going to earn on this asset over time. And the Germans have done exactly the same. The UK, however, has done a market-based approach, which, in my view, has resulted in it being much more risky to invest in renewable assets in the UK framework. And the worst thing that's happened is that they've continually consulting on the process, so that you end up with change feeding through. So you're not really sure what basis you're going to be investing in the UK going forward in the next 5 years. So a lesson across Europe is stability of frameworks, and the French and Germans have definitely got it right as far as renewables are concerned in Europe, and consistency with respect to the way that you regulate these things over the long term. I think it's really important.
It's going to be interesting to see what happens in Europe in following through from the draft directive that was published in September this year into the liberalisation of the EU energy markets. We've got an initiative there being promoted by the EU and its member states. There's a council meeting, I think, in early December to consider the initiative, and it's highly contentious. It's highly contentious in certain European member states. The separation of generation and distribution and transmission. But it's being positive about governments. It could be a real positive step for A, the infrastructure investor, and B, the delivery of better networks throughout the EU. So I mean that's. It's looking forward a bit, because the timing is likely to be, should it be implemented, when the lobbying stopped. I think we're still talking at least 2, 3, maybe more years. But that's a huge potential opportunity for the infrastructure space and players in that space.
But the great thing about that is, I've looked at this now for over 20 years, and the great thing about it is we're having a debate, whereas 10 years ago, you wouldn't have even had a debate, and at least it's being discussed. At least people are thinking about the issues, and at least it's being considered.